Well, I don't, yeah, I guess we'll get started. So, quarter end, happy April Fool's Day and all that. I know no April Fool's jokes, but I mean, a pretty amazing quarter. You saw some of the stats I threw into the little cheat sheet. I was pretty shocked to see energy up 29.5% for the quarter. Not a sector I care anything about, but there was. I'm surprised to see Walgreens up 37.7% and Apple down almost 8%. And then you saw the rest of the stats. Bitcoin, I thought the Bitcoin number sounded weird, up 103.4%. Then I looked back in January and yeah, it was like at 27,000. So, just January seems like a long time ago, yet what Bitcoin Jan 1, you're up 100% in 3 months, which is remarkable, right? The average performance in the S&P per year over the last 100 years is 6 to 8%. The S&P for the first quarter, Bakes, what was the number? Oh, I'm sorry, for the first quarter, the S&P was up 6.17%, the NASDAQ up 1.84%, and the Dow up 8.26%. So literally for the Dow and for the S&P, yearly returns in 3 months. And, the last few days have been, if we've all seen the last few days, growth really seemed to be hurting the last week or so. Interest rates keep going up. The growth trade was definitely kind of, the trade anyway, was sort of falling apart. And all of a sudden, you see, the Biden announcement on the infrastructure bill, and I spelled some of the things out, and all of a sudden, growth is back in the good graces of investors. So was it window dressing for quarter end? Maybe yesterday, but certainly not today. Today's the first day of a new quarter. So I think a pretty remarkable performance. And, I know people like to talk about trading, and we're going to have a presentation in a minute from Casey and Zudor, but when you think long term, some of these returns for a quarter are remarkable. And I'm hoping that, you stuck with your plan, like we always talk about, and added to things at the right time and sort of didn't get, agitated by the market ups and downs in the last week or so. And if you watch the Treasury market a lot, it was Treasury market moved a lot over the last couple of days. Rates, I mean, the 10-year almost got up to 180 at 1.8 at one point, which is pretty remarkable since a year ago, it was at 55 basis points. And, a lot of people on the edge of traders, they're really cued into this. And there was a lot more volatility and growth, which was interesting. So here we are, April 1st, 3 more quarters for the year. If you're a trader, obviously, we're thinking a little bit differently about everything. All right. So first up, today, unless anyone has any comments or questions or things they want to talk about, Casey and Zudor are going to make a presentation of their Berkshire Hathaway to be, I guess, right, Case?
Yeah. So,
as Casey said before, everybody got their Tesla.
No pressure.
No pressure at all. So it's their Tesla, low dollar price stock. And once again, for people who are on for the first time or the last time or whatever, we're not recommending. This is all educational. We're not recommending to go out and buy this stock tonight, tomorrow, the next day. It's information about it in terms of how we think about risk. And one of the things with this stock, they're going to talk about what are the risks in the sector, what are the risks in the company, what are the risks in the market. And, when you put that in your financial blender, how do you think about it? And is it a stock that you want to put in your portfolio? So with that, Casey, Zudor, the floor is yours.
Zud, you want me to go, or you want
I'll start off first.
Okay.
So the ticker symbol is AXSC, I think. ASXC. Ascensus Surgical. They recently just changed their name, which it might. I don't know if that's like a good idea. We might talk about it later, but so they changed their name. So, they focus on robotic surgical, so they basically focus on like laparoscopy surgeries, And the main disadvantages of like normal laparoscopy surgeries is that they usually have like poor depth perception, and they have like limited range of motion, and like they usually have like a lot of, you know, like disadvantages. And Ascensive Surgical, with their Senhance like surgical like system, they're able to like completely get rid of all those disadvantages. And hold up, they they're also able to like cut down on costs like drastically, because if you look at their main competitor, which is Intuitive Surgical, which is like far ahead of them, but it's like good to look at them as a competitor. They have they don't have like the haptic feedback that Senhance has, and they don't have the digital interface that Senhance has. So not only that, if you actually look into Intuitive's like design, um their instruments that they use like for the for like the surgical for surgeries, you can only use them about 10 to 15 times, and then you have to get like a whole new instrument. With Senhance, you can use it and unlimited amount of times. So like it cuts down the cost like dramatically. And if you look at the 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 global like market size for surgical like robots, it was 2.9 billion in 2020. It's expected to be about 8.24 billion in 2025, with a growth rate of about 22%. And with the way Census Surgical is like, if they're able to put their product into hospitals, and they're able to get hospitals to lease them, which is like their plan, I can see them having like a nice market share of this like growing industry.
That's pretty solid.
But before you go,
I think you're freezing, John.
all right, better or no?
Yeah, better now. Yep.
Just one thing. I just want to point out that, and we talked about this before 4 o'clock. We're talking about the medical robotics business, but the market cap of Intuitive Surgical is 88.5 billion. The market cap of ASXC is 814 million. Now, I don't view that as a negative, but Zudor, I think it's kind of tough to compare to the newcomer.
No, yeah, I do agree.
And don't forget, you've got Medtronics, Stryker, Boston Scientific, and Zimmer all in the middle there, all fighting for places in the operating room.
Yes. But like, to be fair though, Ascendant Surgical is the only like digital, I forgot what it
No,
exactly.
Zuder, I know. I'll touch on that. I know exactly what you're referring to.
Go ahead.
Jump in.
Okay, so to add with what Zuder said, it was a really well put presentation. So pretty much a company we're talking about today is ticker ASXC, Ascensus Surgical. The previous ticker beforehand was TRXC, and they were called Transetrix. So why am I bullish? I'll tell you why. I'm bullish due to the fact that, well, I invested in this company early 2020, so I am biased, but it's important to know that previously when I invested, I was aware of the risk and reward. At the time, they didn't have any FDA approval at the time, but I had a hunch that they were going to get it. They were going to seek approval. So this company is a medical device company that is digitalizing the interface between the surgeon and patient, to pretty much sum it up. So it gives you the full experience in a new techie way. Their new system that they're trying to do is called performance guided surgery. And currently no one does that on the market. Compared to Intuitive, all the other the competitors that John mentioned, no one does it. So Ascensus Surgical is different because they have they're trying to go a different route, and their route is called performance guided surgery. Now you guys may ask, what is that? So to sum it up, it's the first of its kind to provide digital laparoscopic platform that leverages augmented intelligence to provide unmatched performance and patient outcomes in the biomedical industry. I'm also bullish due to the fact that previously in March, they were awarded FDA clearance for their Senahan surgical system that allows expansion in general surgery all over the United States. So this was really, really big news. And for people that know the biomedical industry, pharmaceutical, without FDA clearance, you know, you're pretty much stuck in la la land. You know, this is a very big thing. So the fact that they were able to get FDA clearance shows you that they just achieved a big hurdle that a lot of companies in this sector do not achieve. So this, as an investor, would kind of show an attractive entry point. So to also add, it's important to also know that the fact that beforehand this company had debt, they were able to raise $100 million plus, and they are now debt free. So this makes it not only one, they not only got FDA clearance, but now two, they raised $100 million plus, and they're now debt free. So those are two attractive points to keep in mind. But they not only create a product, but a new application, which I mentioned before, which is called performance guided surgery. I don't like to say competitor, but I will say there are a lot of other players in this industry, and I can mention Intuitive Surgical. The ticker is ISRG. I would say they're the current leader in the robotic surgery, but there are other players as well. So I do think there's fair share for everybody. In my opinion, I would say that Ascensus is the Tesla of the robotic surgery, in my opinion. They have a lot of strong patents as well that I will talk more about. They're also looking to expand not only in the United States, they're looking to expand internationally. Currently, they're already looking at expanding Europe and Japan. The current market cap of Ascensus is 793 million. I think John mentioned 814. It may have changed in the past couple of days when I finished my report, but it's less than 1 billion to give you a broader scope of what the market cap is. And for ticker ISRG, they are around 89 billion. So you can already see how you can see the risk reward currently. You see how with Ascensus, yes, it's below $1 billion market cap, but if let's say this does plan out to be right, it has so much room to grow. So that's something also important to keep in mind. Now, the questions may be, what are some of the cons? You know, every company has their own cons. Personally, in the previous years, they had a very poor management team. And also they struggled a lot with bringing, you know, their concept to life and getting FDA approval. So in the past years, they were able to, one, fix their management team, two, clear their debt, and also get FDA clearance. So, you know, they have really done a complete 360. So I think it's important to notice that also. They were able to get a patent for their wide angle camera, which is very important when, you know, surgery is going on. It's very important. It also shows that their technology is exclusive in its own way. And you may say, okay, they're the small guys. How come? What if Intuitive Surgery comes out and knocks them out and buys them out, or says, okay, we're better than you guys. We can do what you do. I don't see it happening. You know, they have their own technology, their own niche. And the fact that they have their strong patents being approved, it shows that they have something that's credible. So, like I said before, I think there's a lot of room to grow, super long-term. Also keep the fact that they're looking to expand internationally because, you know, even though the United States is a big player, this is a full international game, you know? So the last thing I will add is there are a lot of new catalysts left in 2021 for this company. I think you should keep your eyes on. It's important to know that they're incorporating a new look of AI into the science industry, like into the science, you know, robotic surgery. So with everything I've said, the last thing I will say is that there was something I found really, really cool about Ascensus. When operating surgery, you know, every company has like the tools they use, like of how large or how small they are. Currently, their exact measurements are 3 millimeters, and it's the smallest in the market currently. And this just means, you know, smaller scars, you know, less, you know, the smaller the scar whatever part of the body is being worked on. So that was a cool fact that I found out about Ascensus. But other than that, I think that's pretty much it. If you're curious to know what laparoscopic surgery is, it's a surgical technique that's used dramatically in the, science industry, that is used with neurotubes to, insert in the body and operate in the body, to really sum it up.
And they're also like CE marked in Europe, and they're PMDA approved in Japan. So like those are like the two markets they really want to focus on, and they already have like they're already approved in those areas, and they also have a cash runway all the way up to all the way up to the fourth quarter of 2022. And sales is like their biggest like problem, because like they've had a like problem in the past, like Casey mentioned, with like their past management. They had a problem with getting these hospitals to buy their product. And what they're doing now, instead of just the hospital just buying it out front, they're letting the hospitals lease them. So like they're just getting paid either by the year or the month. So it's gonna be, as long as they get that like down packed, I feel like they'll be able to make profit for the next coming.
That was really important that he mentioned that. But also just lastly add, it's also the fact that, this is a new company, but they're still in their early stages where they're, right now they're investing deeply into the company, so everything they bring in is going right back to the company to really just get this out there. So it's important to keep that in mind. But when I talked about the management team, it's important to know that their CEO currently previously was on Stryker. So that's pretty bullish if you ask me. But yeah, that's pretty much it for me.
Can we ask questions?
Yep, get in there.
3 questions. So you mentioned, you segued into it nicely, sales. So if they're getting away from a sales model, going into a lease model, it requires capital. They have to, build the machine, then lease it out. So that requires working capital. Second, how much cash do they have on the balance sheet, and what's their cash burn? And where I'm heading on this is a lot of these $3 stocks, $10 stocks, whatever, when they run out of money, they have to do at the market offerings, which are usually at a pretty big discount. So I'm curious whether you have a cash flow model built as to when they run out and when they're going to need additional financing, and how you think it gets raised. That's it.
What say you, Casey?
So to answer one of your questions was the fact that, do they have cash on hands currently? I want to say yes. I don't know that exact number, but I do know that what you mentioned before, companies usually, below $5 stock range, they tend to do the stock offerings to raise capital. So I could see it in the future happening. I don't see more as a bad thing, as long as it's controlled and at the right time.
And you did bring up a good question. I'm gonna look up into that, because that's actually pretty important, like the cash, like the cash burn rate. But I believe their cash and restricted cash, like combined, is about 17.5 million. So I don't know about the cash burn rate though. So
yeah, I can't give you an exact number, but I can tell you now, when I was looking into the company, I know they're burning cash aggressively. That's why I said everything that comes into the business, they're investing right back into the company. But is it usually with companies like this in the biomedical pharmaceutical sector, that's kind of what happens usually when they're starting out trying to prove their concept. Everything really just goes back into the business. So they are burning cash quite aggressively, and it also is important to fear that, with the current market stability, what's going to happen for the next, 6 months, 1 year out. Is COVID gone? Those are still important factors. So can this company survive another crash? Those are definitely fears that I have thought about too as well. So I keep it in mind, but I do think that, they'll be okay.
Okay. For what, am I muted or not? No, muted. Okay. So just cheating on Bloomberg here shows them burned $50 million last year, 70 the year before, 50 the year before that. Assuming they stabilize that with their debt repayment that you mentioned, if they have $17 million of cash, they're out of money in 3 months or 4 months. So I think my 2 cents would be, talk to the management team, call them up. Shockingly, sometimes they pick up, and ask them what their plans are for cash and where they see their cash burn, if they have a way to address it. That'd be my 2 cents.
So Casey, I also think a lot of that money is going to be used for marketing, because as we were talking before the call about how these make their way in the world, and a lot of it is spent on literally wait, are there any surgeons on the phone, by the way? Any knee surgeons? No. But these medical robotics companies have to woo the surgeons. And I know Ken's on, whose brother's an orthopedic surgeon, and there was another not ASXC, but another company called Mako Surgical, which if you get your knee scoped now, you go see a doctor today to get your knee scoped, and he or she's going to tell you, I am going to use Makoplasty on your knee because it's now used universally for knees. But when this company first started out, they actually had to go doctor by doctor, surgeon by surgeon, to try to woo these people, because surgeons think they're God, as they should, or maybe they should, to use these machines. And surgeons were very hesitant to use them. And all of a sudden, when you start using them, you realize, okay, instead of doing 2 or 3 knees a day, I can do 10 knees a day, which is much better for my income. So the history of Mako, which is I know a couple of the guys on the call know the history because a few of us worked together, and the guy who funded it sat right next to us. But this company almost went out of business 10 or 15 times because they kept running out of money. So to Steve's point, Case and Zudort, one of the things you really got to think about is what happens if they have a cash crunch. Do they call up Intuitive Surgical and say, okay, guys, we got the right product, we got our CE mark, we got FDA approval, we're out of money, can you help? Do they raise money from the market, which if they do that, it's going to push the price of the stock down. You saw that with AMC today. Oh, the world's coming back, the world's normalizing, people are going back to theaters, and AMC says today, oh, we got to sell another 500 million shares. And that changes the price of the stock. Same thing, my same contention with GameStop is one of these days they're going to come in, and as Steve said, an at the market offering. And for ASXC or GameStop or AMC or whatever, what's the clearing price for another batch of either new investors or existing investors or tired investors to keep investing? And below $10, institutions are very loath to participate. So this could be, this product could be the best product of all time. And this company could be sold to Stryker or Medtronic or Intuitive for $5 because they run out of cash. So you got to be really careful with the cash burn and the cash loads. And to Steve's point, if you just go onto their website, you'll see a phone number and the investor relations person. You can call them, and oftentimes they will just talk to you and tell you exactly where they're at and what's about to happen. And it's probably worth doing one day next week before you add to your positions. But you're in the right space, right? And next time I go get anyone on this call gets an operation, you're going to say to the doctor, well, what medical robotics are you using? And they're all going to say, well, I'm using Intuitive or Stryker or Medtronics or Mazor or something else. It's just the way it's going to be. And it gets more prevalent every day because the robotics get better every day. As I said before on the call, though, one interesting thing in the operating room, I'm not a doctor, but in every operating room, when you have a Makoplasty unit or an ASXC unit, there has to be a rep from that company monitoring the surgery in case something goes wrong. You imagine someone scoping, you're asleep, the guy's scoping your knee, and the guy said, well, the arm's not working right now. What do you kick it? You hit it with a hammer? No, you got to do a software fix real quick, or you got to proceed to plan B. So that's why a lot of reason operating rooms are medical robotic reps have to be in the operating room, which is sort of interesting, I guess. So just things to think about. But the cash, go back to Steve's point, the cash burn is a really big deal here. So Casey, Zudort, I would check on that. And I'm also curious, how much stock does management own in the company? One of the questions, before I buy a low dollar price stock, I say to myself, okay, does management own the company? Are they buyers? Are they sellers? If there's not at the market offering, are they the lead buyers, or do they participate? And again, this is something you can see in Barron's every weekend of the Wall Street Journal, but I really key on that. If management's putting money in the company, that gives me a warm and cozy feeling. If they're not, or if they're selling, that gives me another feeling. So I would check on that. You said that one of the guys there is from Stryker. You're right. That's a good thing. But is he personally invested in the company would be my question. Okay. Anybody else for these guys? Not easy to do, right, Case?
And
Right?
the reason why I became so bullish too, because I have my cousin, her friend's a doctor, and they actually used the equipment before the company.
Why didn't you mention? You should have mentioned that. That's a big.
Yeah.
That's
No,
a-
yeah, I didn't mention that at the beginning, but that's one of the reasons too as well.
Yeah, my friend, so Kenny and I were talking about this Mako thing, and his brother's an orthopedic guy, and he, for years he was like, yeah, this is crap. Then he starts using it, and it's all good. And then a light bulb goes on. Well, if he's doing it, then other people are going to be doing it too, and they'll sell more machines and more service agreements and that kind of stuff. That's how personal, business is and Wall Street is, which is interesting. It's not strain. It's you got to really dig down to the personal nature
Wow.
of these things.
John, I completely forgot to mention this. You mentioned institutional ownership. I had it written down. There are some institutions that two big companies can give right now, BlackRock and Vanguard.
Okay.
But there are there's about like 70 more other institutions involved with this company. I don't know how I missed that.
So here's the thing. Let's just talk. So I know, Steve, you have a Bloomberg in front of you?
Yeah, give me a second. Vanguard's 0.93% of the shares outstanding, so it's a rounding error, an index fund somewhere.
But
BlackRock's 0.25%, again, a rounding error. So I wouldn't get too excited about that.
so Casey, when I see BlackRock or Vanguard, it probably goes in a lot of funds at the company or Fidelity, Strike or Intuitive. That's who I want to see as an investor. Now you may never see it, but that's the kind of investor I want. I want to see an investor who knows the space, who's got a vested interest. A lot of these stocks, when you see a Vanguard, they could put it in 50 different funds or in, 8 small cap funds, that kind of thing. And it's not bad or good news, but it's passive.
Yeah, but I mean, John, in perspective, Vanguard's got 3 million shares. So that's worth $6 million.
Yeah.
Vanguard manages how many trillions?
Yeah.
Yeah, they don't.
You hear that, Case?
It's not even a rounding error.
Yeah, I heard that. Yeah.
So it's good news, but it's not meaningful for.
Yeah. I mean, if they owned 8, 9, 10% of it, that'd be impressive. But fractions of a percent is.
Yeah. But also,
what about, John? What
Yeah, go ahead,
about like venture capital funds? Are there any venture capital funds that are heavily invested?
Bakes, do you see anybody?
No, there's one up top called Empery Asset Management. I actually don't know what that is. They own 4% of the stock. Savvy Management, which does a lot of healthcare, owns 2% of the stock. But again, you're talking $10 million investment for Savvy, and these guys have a $400 million plus portfolio plus whatever they manage outside of it. So I'd say it's a minor position for anybody that's involved.
So just so you know, Steve has a Bloomberg in front of him, and the good news about
Yeah, it's not from memory.
Yeah, but when FDU is back open and the Bloomberg Lab's open, you can go sit there and you can go through company by company and see the investor list, who's buying, who's selling, and then you can get a snapshot of who the investor is. So when I see a healthcare investor in a new healthcare company, like Kasdan happens to be CASDIN happens to be a big name in healthcare. When I see they're in a SPAC or a PIPE or something like that, I get pretty excited because really, really, really smart. If you look at the holders of DermTech, which we talk about from time to time, there's very savvy holders, very savvy long-term patient holders. And then you go down the list, and when you look at, stocks that are, more speculative than something like Intuitive or Pfizer or Johnson & Johnson, when you look at like Exact Sciences or Semler or DermTech, which I throw those three in the same bucket, I like to see that the investors are people that, have many investments in healthcare, but that's their specialty. And so when you're doing your research on individual companies, it's really important to see who's buying and who's selling. And that's kind of interesting. There's another company called Schrodinger's, the ticker's SDGR. I'm just bringing this up for the investors in it. But what they do is they help drug companies bring their drugs to market. They speed the years ago, but the company was founded 25 years ago by two people, Bill Gates and David Shaw. So David Shaw runs this huge black box hedge fund, but he's a brilliant guy. And obviously we know Bill Gates. Trades very well. And all of a sudden I see both these guys selling stock. And I'm like, well, wait a second. I'm buying stock and I'm not as smart as these guys. What the heck am I doing? And literally they've been in this deal 25 years. Between the two of them, 45% of the company, they're going to peel off a little, not that big a deal. But if they were to sell their whole position, just like if Elon Musk came out over the weekend and said, I'm selling half my Tesla, the world's going to change for all these companies pretty quick, or Bezos, or, all the other people we talk about. So,
John, I'd throw one more thing in there for Case and Zudart. If you do have access to Bloomberg, it's pretty easy. See who covers the stock, meaning on the institutional side. I mean, do you have JP Morgan behind you, Goldman Sachs, guys like that? In the case of ASXC, you've got obviously small cap guys. We have Ladenburg Thalmann, reasonably decent reputation, and Raymond James, probably mid-ish cap with a halfway decent reputation. But you want to see more than two guys covering a stock. That means the management's out there talking about it, trying to move the stock up. But always look to see if the thing's covered on the institutional side, because otherwise, if it's not, you'll never find institutional buyers for it.
Thank you. Appreciate it.
Yep.
but remember last week when my
One
kid,
thing where, John, I just want to jump in on that statement. I want to disagree with one thing you just said, Steve. And when I find management is out pumping the stock, that's a red flag. I want management to be out informing the analysts about the stock, but trying to get the value up by doing that is not what I want them to do, because I want the stock to move because the company is performing well, not because the analysts are being pumped to move the stock value. And there's a fine line, but there are too many CEOs or CFOs that go out to tell the analysts to go trade the stock and move the value, move the stock up. And that's a bad idea, because then the stock will crater.
Yeah, so Rich, I would actually agree with you. I was trying to be a little diplomatic when I said Ladenburg Thalmann is mid. Yeah, we're on the same plan on that. There are two different types of management teams that are out there trying to pump the stock up. For instance, these guys clearly need their stock to go up because they're going to need to raise more stock money at some point. So I would expect you'll see nothing but good news in the near future. But I agree with you 100%, Rich.
Okay, thanks.
Yep.
So just so you know, for students on this call, we're starting to get more Wall Streeters on this call, and the discussion's kind of getting a little bit elevated, which is good. But if there's something you don't understand or doesn't make any sense, please stop and ask, because we've got this group is getting much more diverse and we're kind of elevating the conversation a bit, but you don't want it to be over everybody should understand everything. Okay. So from what, Rich and Steve are talking about, it just goes back to how, and I've said this time and time again, how Wall Street is very personal. It's a very small little cliquey kind of thing. And you really got to pay attention to these analysts who talk about stuff, who raise they'll talk, as Steve said, you can call these people up and they'll talk to you about why they're doing it. You heard my son last week, they don't change price targets unless they're going to change it by 15%. And when a stock goes up, all of a sudden you're at a new price. How do you get a customer to keep, so there's a fine line between marketing and, common sense. So when I see that, today, UBS came out with a 40-page. So UBS, my guy calls me UBS today. Oh, Apple, we got a 40-page report out. Oh, the EV cars thing worth $14 a share. The guy's got a price target of 142 on it. And I'm like, all right, send me the report. So it's 40 pages long. I'm about to take my nap and I'm trying to read this thing. And I'm literally asleep in 30 seconds because, yeah, they might make an EV car. It might be worth 14 bucks a share. All this good stuff. And if you bought Apple yesterday, a year ago, 20 years ago, you're like, great. Well, we'll keep it going. I don't need 25 bucks a share when they say it may be worth 142 bucks a share. So, after you hear from these people time and time again, you're like, well, slow down there. The upside, doesn't seem as good as the downside possibly could be. So everything with a grain of salt. When we get back into school and work on the Bloomberg, though, you're going to see all this stuff right in front of it. Now you're going to get it like, oh, there's Kasdan, there's Dave Tepper, right? Casey, what's the question?
No, I was just curious to know if we were going to talk about the new news that came out with Ethereum last week with Visa.
You can talk about Ethereum?
Yeah, Ethereum,
You mean a Bitcoin kind of thing?
Yeah. Bitcoin, Ethereum, Litecoin, all of it.
Go for it.
Okay, it's pretty much Visa became the first major payment network to settle its transactions in cryptocurrencies, allowing crypto to make fiat payments in USDC. And this is with Ethereum. So that's kind of why Ethereum was up dramatically the past week and a half.
You're saying. So yesterday, PayPal came out and said, check out with crypto, right? So I actually read the news.
You remember what I said a few weeks ago, what would change the cryptocurrencies from speculation to a real commodity? And that is when they can be used in commerce, number one, and when you can put them into your bank and use them. And here are two examples that they're starting to be usable in day-to-day commerce.
Yeah.
That takes the first area off the table.
So it's all really good news. And then Starbucks came out today and said, all right, you can pay with Bitcoin now. But I think, as good as all this stuff is, don't forget, when you pay for a cup of coffee with Bitcoin, it's a taxable event, right? We keep forgetting this. So you bought Bitcoin at $1 10 years ago. You're going to sell a little piece of Bitcoin to buy a cup of coffee. Then you got to pay tax. And
it's going to be hard to track.
Really hard to track.
It's going to be hard.
But when you liquidate something from Coinbase, I think the first question they ask you is, what's your tax ID?
Yeah.
So, it's not good or bad news. It's something you got to take into account. If you're going to buy a Tesla with Bitcoin and you've got a huge profit in Bitcoin, that's great. But you're also going to have a tax bill, along with that. And
John, what if you don't actually sell? What if you just do a transfer? Like, what if you just transfer it out like normally from network to network?
Well, but if you're paying for something with it, you're
yeah,
effectively selling it.
Yeah. If there's a transaction, I think it's a
You
tax.
can't avoid it. Yeah, I'm just trying to see how you can avoid it.
Casey, there's no avoiding death or taxes, right? Neither one of them. But it's just something to think about. So speaking about, let's anybody else on Bitcoin? We can go back to that. I know it's a hot topic. Bakes, Lori, anybody? Victor?
I would say with Ethereum, I feel like with NFTs, even though NFTs is kind of like a shaky thing to even be dabbling in, I feel like there's a lot of untapped potential, especially with NFTs being like on the Ethereum blockchain. I feel like if NFTs like have like the ability to become something big, it's gonna really push Ethereum, because Ethereum has like a lot of when compared to Bitcoin, the amount of transactions that's on Ethereum, like it's like, I forgot how much it is, but I think it's like over 200% more than Bitcoin. So I feel like as long as Ethereum has more stuff on its blockchain, like on its like transactions list, it can help Ethereum become something just as usable as Bitcoin.
Well,
Has anyone on this call born? I'm sorry, Rich, go ahead.
So I posted up to the LinkedIn an excerpt from my venture funds program where they covered a lot on the NFTs last week. I hope some of you got to look at that. But I have a contrarian view on NFTs. having lived through lots of cycles of the boom and bust over the last 50 years. I believe that NFTs are another, Beanie Baby or Cabbage Patch Doll kind of thing. And I caution you guys very carefully on your enthusiasm to go out and participate in NFTs. They're very expensive for what you're getting, and you're buying something that is speculative in the wildest sense of the word. You're buying something because it's exciting and because someone says it has value. And my caution to you is they're scarce, and that's what's driving the value up. But what are you really buying? Whether it's a piece of virtual art or a virtual video or a virtual clip because you own a clip that's the authentic clip of something in sports trivia, sports memorabilia. Be careful. I'm giving you my heart because my fund is giving a lot of information out. You can go listen to people from around the world talking about it. There's a company called Sandbox that we are, big owners of, that does a lot of NFTs right now and selling a lot of them. But I'm telling you guys, be careful because I think this is a very short-term boom, and it's gonna. I think it has air in it that will come out very quickly. That's my own opinion. I'll be
So,
quiet on the
Has
NFT.
anyone on the call bought an NFT yet?
I know Casey has. Right?
No,
Have you
yeah,
bought- Have you bought and sold or just have you bought and sold or just bought?
personally, me, I bought an NFT on Top Shot, and before I was very like speculative, but when I started to really like look at like what they were offering, like I didn't know they had a deal with the NBA itself. So like it's very interesting because let's say like if they were able to like release like a pack, so they release packs, and in these packs they have different types of moments. So like right now they don't have any moments that are like well known. So like let's say Jordan's like free throw line dunk. If they were able to release that, I feel like numbers on that would be crazy. Like just to release like Jordan's free throw line dunk, that would be like a pack that would go crazy, in my opinion. But I'm just being speculative too right now. So it's just me just thinking about it.
Mm-hmm. Interesting. Arcadia, you want to give us a couple minutes on the New York real estate scene? If you can.
Sure.
How you feeling?
Hello.
Hey.
Feeling busy and tired. That's how I'm feeling.
Well, so a month ago, a month before you start, a month ago, you were 2 months ago, you were kind of blah, and today you're busy and tired. So let's hear what's new.
Yeah. I think the last couple of weeks, we've also been back to work and, in the city 5 days a week. And, after a year of not doing 5 days a week, it's amazing how exhausting 5 days a week with a commute, getting dressed, thinking, working, arguing about deals, trying to make deals. The delta between the bid and the ask is so far apart right now where you have to just, it takes like 4 or 5 rounds to get to a transaction or some sort of transaction. And then even when you're there, no one's really happy at the end of the day because both parties like, oh, they're screwing me. And the other side is, oh, they're screwing me. And no one really knows sort of where the economics should be because when the market's tight, right, you're like, all right, there's a 5% delta. Or if the market's super weak at the bottom, you're like, all right, there's a 5% delta. But when there's such a big gap, it's just a lot of work. But I would say, there's been some good news from like Morgan Stanley, Amazon, Google, Goldman, that they're like, hey, this is enough. We're going back to the office, at a certain date. And then the other thing that we've started to see, and then this is actually just only this week for the first time, is we started seeing firms that had sublease space on the market start pulling it back, where they're like, whoa. One, we're getting way too aggressive offers, and we're not there. We're not going to we'd rather keep it than discount it. So there's, like McGraw-Hill, I think part of it's because, I think Apollo's looking at some of their like education arm, but they pulled a lot of space back off the market. Third Point, which is actually Dan Loeb, he had some space on the market, some of his space on the market at Hudson Yards. I think he saw, some pretty aggressive proposals. And he's also like pulled some space off the market. So we just started seeing that. So I want to see, in a month, sort of where the stats take that, because that's a positive for the market when space comes off. And again, I would say that we're we're obviously way busier than we were even like 6 months ago. And there's parts of Manhattan, like Meatpacking, which has a bunch of boutique new buildings. That part of the market is like Miami in New York. There's just so much unbelievable activity. It's like 4 months ago when we were out there, like, all right, look, just pick your top 3. We'll go, we'll negotiate, we'll see where we land. Now we're like, 4 to 6 options in. There's like proposals in or leases out, which is like pretty shocking to see, because even in the good market, Meatpacking kind of, if there was new product, it wasn't even new product, wasn't that quick to move, specifically in Meatpacking. So it's kind of interesting to see really that market be so active, even in the middle of a pandemic. And again, there's also, there's big, like Two Sigma, which is a big quant fund, actually started by 2 guys also out of D. Shaw. I think one of them lives in Short Hills, but just, touching on the Schrodinger thing where, a couple of other guys from D. Shaw started a pretty crazy fund. They're out there they're shopping around for about 500,000 feet of new office space. At the end of the day, I don't think they're going to move anywhere, and they're not going to do anything, because if you look at the cost, to go build out, 500,000 square feet of new space, it's going to cost them, even if it costs them $250 a foot, they're going to look at those economics like, hey, I'm going to go lease space. I'm going to spend $150 million on building space out at the end of the day where I don't even own it. I don't think those guys are in that mindset to do that. So I think at the end of the day, they're going to stay where they are in Hudson Square, but it's nice to see such a massive tenant out there shopping around. There's obviously a lot of options for them.
So I want to segue. Sarah Hoff, can you talk for 30 seconds? Are you around? So one of my, an FDU grad, now works in the Miami real estate market. Sarah, you want to give us a little, couple of sound bites about Miami?
I'll text her, John. I'll text her.
If she wants. I just like to get, I like to see, the kids who went through the Silberman program and what they're doing and how they're doing. Sarah just started a job down with Sotheby's in Miami. I think she's doing great. I think the market, as Arcady pointed out, is just red hot too. But I just wanted to see if anything was different down there. She's busy. Okay, we'll leave her alone. All right, last thing. We only got anybody else? Rich, you got anything else new?
No, I just sent an email out. Check this Sandbox situation out, because it's an interesting play. It's a private company, but they're going to go public very shortly, and they create a virtual real estate world for gaming, and they sell NFTs at the same time, and they've been hitting it out of the park.
Okay.
So you might want to follow them. And then also, thanks, Casey. You did look at that blockchain gaming world on the NFTs, and it ties in with Sandbox. So you guys might want to look at those 2 things.
All right. So just last thing on the Biden infrastructure report, on the proposal anyway, $620 billion for roads, ports, bridges, $100 billion for high-speed internet for all.
You can use that, John. You can use that high-speed internet, John.
I know.
Your internet slows down.
I know. I'm going to get a new computer. I know. I'm a dinosaur. $111 billion to fix water pipes, and $100 billion to retrain workers. So when you're thinking about how to play that, or how to invest in that, or how long-term that is, first of all, it's probably going to take more than 5 minutes to put all this stuff to work. You know, there'll be committees and working with the government, and anyone who works with the government. I know there's some people on who do business with the government, how hard it is to get into their network of their contract network. So there's a lot of beauty contests, but once you're in, you're in. So if you find it like a company like Xylem, XYL, no, I'm not saying to buy it, but they make water pipes. And it's sort of like, you think it would be a natural company to get a lot of contracts from this plant. Don't know if that's going to happen or not, but once you're in, you're in. And that's the interesting part. So if you can target companies in these spaces, I think the runway is pretty long for their earnings power. If you know, there's plenty of ETFs that buy infrastructure ETFs. There's one that tickers PAVE, PAV. I mentioned it last week, that before you buy it, and I'm not recommending you buy it, but before you buy it, go in and take a look at what's in it. Or HASI, another one, go see what's in there. And if you don't want to take single stock risk, just buy these ETFs. And, you know, it seems to be, you know, a little bit of a no-brainer if they're going to spend all this money. And this is the first, there's going to be 2 parts to this plan. The next thing was the plan is being funded from raising corporate taxes, not capital gains taxes, not income tax. And I thought that was really interesting, because usually when the government does a big plan like this, they throw the whole thing out in one fell swoop, not to mention the capital gains tax going up or individual income tax going up. You know, that really, I think that's another reason the market's done so well the last couple of days. People are going, well, they're not going to do it in 2021. Maybe if corporate tax fills in the gap here a lot, they may not have to do it, or may not have to do it in such a draconian way. So I think Mr. Market is starting to realize that your tax bite is not going to be as draconian as you thought a week ago, 2 weeks ago, 4 weeks ago. And that's interesting. So when you think about where the market is today versus, you know, 2 weeks ago versus January versus a year ago, it's incredibly remarkable where things are. And if you listen to the Wall Street pundits, you know, they have lots of very high price targets on the S&Ps. This whole thing continues. Not sure. You know, the other Wall Street adage, which I put in the newsletter, is, you know, sell in May and go away. And, you know, you take your profits for the first quarter of the year and you revisit it again November, December. And a lot of people, you know, trade that way, not investors, but traders. So I think the volatility is going to pick up. I think interest rates are, you know, every day you got to kind of take a look at interest rates.
Yep.
Really importantly, Bitcoin, gold, oil, very, very topical. And I think as the market goes up, it gets more risky, right? So when we think about going back to thinking about risk every day, headline risk, media risk, inflation risk, interest rate risk, every day the market goes up, to me, the market gets riskier. It doesn't mean I'm selling anything, because I'm not, but I do think about it, and it's starting to keep me up a little bit at night.
There's an expression I would leave everybody with when you talk about that. There's an old expression that I remember, and that is, the trees do not grow to the sky.
And that's the truth.
And you,
So
so
even
you
if
have
you look,
to, you have
you
to
look,
remember where that's going to stop. Think about it.
you know, look back on your favorite stocks if you're in the Cathie Wood stuff or the Bailey Gifford, Bailey stuff, you know, even they talk about, you're going to get these drawdowns once in a while in a lot of these names. But the key is if you stick with your plan, I think that's the best way to do it.
Yep.
Anyway, we are out of time. Anybody else last minute things?
Yeah, John, can I ask Rich a question?
Yeah, you can, of course.
Sure.
Yeah, I have a question. So since you do a lot of work, you know, with venture capitals, right? And you're like, you know, let's say past 10 years, the name Chamath, like, does his name come up anywhere in the VC world, anywhere with his current works, you know, with SPACs and the companies he's brought to public?
Which name?
His name is Chamath Patha. I can't pronounce his last name, but pretty, you know, Chamath Patha. I can't pronounce the last name.
I don't think so. I don't recognize. That doesn't mean anything. but
Okay.
I don't recognize it, I'm sorry to say.
Casey, he's capitalized on the SPAC craze, and I have a sneaking suspicion in 5 years, you'll never hear from him again.
Yeah, I'm just curious to know people's thoughts on him because I know, like, you know,
Well, he's a
all the
seller.
SPAC.
He's really a seller, right?
Yeah,
You don't want the company leaders to be sellers. And he's always selling stuff. And that's the problem I have with a guy like that.
I mean, when he was preaching Bitcoin and Tesla, you know, like 3-5 years ago, he kept talking about it and why he's so bullish. And I mean, we see now that he was right, but I don't know if every
Okay. A lot of people are right, but
yeah.
when they do one thing, when they say one thing and do the other, that's when I put my hand up and go, that's not right.
Yeah, I mean, if you have a standard philosophy of your investment philosophy and you stick to it, that's okay. But and philosophy is, the methodology that you buy and sell. And if you're consistent and you're not trying to catch the market and move the market, that's okay. It really is. But if
Casey,
you're trying to move the market or catch the market,
Yeah.
that's going to bite you in the ass.
Casey, read Howard Marks' last letter. I tell you to read every letter, but the last one is real. The last two actually are really good. And then read the Buffett letter from his annual report, and you see what a long-term investor. I know they're old white guys. I get it, but they also have a really good investing history of how they look at things. And Howard Marks is very brilliant and easy to understand. So I get some more points of view than just Shemad, I think. All
Okay.
right.
Thanks for that, John.
Okay.
Happy Good Friday. Happy Easter. Be safe. If anybody wants to present next week, God bless you. Anything you want to talk about, text it during the week. So text it to everybody so somebody who knows something about it can get a handle on it, which is good.
Okay.
Well, we obviously have people with lots of different strengths, right?
Yep.
From Rich to Steve to Kenny to Mike to anybody. Everybody's got to chime in here because the market is all about opinions, right? And that's what I love to hear when Casey and Zuder, thank you so much for today.
Okay.
Running it, and now you got to rethink it a little bit and come back to Steve next week and put him in his place. Tell him why he's wrong. That's the nature of the beast. And then maybe Steve will hire you, give you a big high-paying job at his firm. All right, see you guys.
All right, guys.
Bye.
Happy Easter.
hope so.
Happy
everybody.
Easter.
Thank you so
April Fool's
much.
Day.
Goodbye. Have
Bye.
a nice day.
Bye-bye.
Take care, guys. Have a good one.